Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian McMullen, fixed income strategist, ETF and Indexed Strategies at Invesco, to discuss where investors are allocating capital in the fixed income market space. Brian, it's great to have you with us. Welcome to TradeTalks.
Thanks, Jill. Good to be here.
You got it. And give us a quick update on what's happening in the fixed income market, and where have you seen investors allocate recently?
Sure. Well, obviously the focus in fixed income markets this year has really been all about inflation, and I'd say more importantly, the Fed's ability to tame inflation with interest rate hikes, right? And it's been interesting because for the last 12 months or so, the market's expectation for the path of rate hikes from the Federal Reserve has really been all over the map, right? So at the beginning of this year, you look at what the market was expecting for the terminal rate, it was just south of 5%. And then they were looking to finish 2023 with the Fed's fund rate around 4.5%. But if you fast forward to today, right, so we just got another 25 basis point hike. We'll see if it's the last one. And the market is calling for a Fed's fund rate today of around 4% by the end of 2024, right? So all that to say, I think investors are feeling more confident now that we're reaching the end of the rate hike cycle, and they're really starting, I think, to ask the question of how should we think about adding duration to a portfolio, and what are some of the best vehicles to implement that type of a strategy. And so when you look at ETF flows year to date, it's exactly what we've seen. So it's been a fantastic year for fixed income ETFs. Across the board, we've taken in over $110 billion in net flows year to date as a U.S. listed fixed income ETF industry. But if you take a closer look at those numbers, over 50% of fixed income ETF flows have gone into either intermediate or long duration bond ETFs. So I would say, we've seen pretty strong preference from ETF investors for longer duration strategies, especially relative to what we saw last year in 2022.
Let's talk about this some more, adding duration to a portfolio. What are some potential ways that investors can do this in the current market?
Yeah, so there's a number of ways to add duration, but I think it really comes down to an investor's risk tolerance at this point in the cycle. And what we hear from clients is that the preference today, where we sit today, is really for adding higher quality duration at this point. And I would say it's really twofold. There's really two reasons behind that. So one, higher quality bonds are offering some of the more attractive yields that we've seen in decades at this point. And so when you think about it from an investor standpoint, this is really an opportunity to lock in some of those higher yields over longer periods of time and longer duration. So that's the first reason. I'd say the second reason is really because if investors want to be higher in quality at this point in time, it's really because their outlook is that, hey, we are likely entering into a period of slower economic growth and or a recession in 2024. And so really what we've seen is a lot of the ETF flows this year in the assets, they've gone into longer duration categories, but they've really kind of anchored in U.S. Treasury products. And so, within our lineup at Invesco, one of our longer duration Treasury ETFs, PLW, has been a big focus for us lately. And I think it's been something of strong interest and demand that we've seen from our clients for this type of a strategy in this market.
So tell us more about the methodology behind PLW. What makes it unique in the ETF space?
Yeah, PLW is a really unique product. It's very simple at the end of the day. So PLW is an equally weighted 1 to 30-year Treasury portfolio. So that means that we're going to own bonds across the entire U.S. Treasury curve, so 1 to 30 years. But instead of weighting the bonds by a market cap or issuance-based methodology, which is pretty standard across most broad Treasury indexes, we equally weight each maturity in the portfolio. We rebalance the portfolio back to those equal weightings once a year in February. And so really what that means for investors is a couple things. So one, PLW is going to tend to be longer in duration relative to your kind of traditional 1 to 30 year issuance weighted type products. The second is PLW can really offer a more targeted duration relative to some of these other benchmarks that are out there because of that disciplined, equally weighted laddered approach to the portfolio. So, we often use the term intelligent income when we describe our fixed income ETFs at Invesco. And really because we're trying to be more thoughtful and really offer clients differentiated strategies and approaches to some of the more traditional ways that investors have accessed the bond market. And so when I think about PLW, I think it fits perfectly into that category of intelligent income. And I think it's a really unique way for investors to be able to access the treasury market in today's current environment.
All right, Brian, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.